All right, good morning for those of you on the West Coast, and good afternoon for you in the central and eastern part of the country. Nick, Matt, and I want to thank you for joining us for our 3Q webcast. When markets are challenging, participation is relatively high, so we want to thank all of you for joining this webcast. It is recorded, and we'll also send up a follow-up link. So obviously, this is a really challenging period. It's been a very, very difficult 9 months in the capital markets for investors. So over the next 30 minutes, we're going to talk about kind of how the markets have performed, our general positioning across client accounts, and then where we see the market going. So I'm going to kick it off by talking about kind of a couple of current initiatives at the firm, and then Nick and Matt will talk about the markets. So many of you have received recently an email from me to link you to our new client reporting portal, which the back office firm that we use is called Orion. Orion is one of the largest technology software companies in the world that's dedicated to financial services. And we started working with Orion in the June of 2021 to build out a powerful information portal. So we're just showing you a little bit of how it looks. I know many of you have already registered. There was a 24-hour window. It's for security reasons to be able to create a login. We also followed up with instructions on if you miss that 24-hour window to reset the login and to use the portal. We think this is a very powerful device that will allow you to track your portfolio effectively. There are a lot of capabilities which we will continue to add to it. But one of the things we find very helpful is through beta testing with specific clients. It's an easy snapshot to see how your portfolio is valued, the portfolio positions, performance. And over time, we'll be adding new functionality, like we'll be uploading our research reports, quarterly commentaries. In fact, we'll even be using videos going forward to help describe certain new programs at the firm. So this is a powerful tool, and it's important that we hope all of you use it and register as quickly as possible. If you need any help, reach out to any of us and we can do that for you. And the next thing I want to mention is an invitation was just sent out. We are going to be hosting Drew Sharp from Hamilton Lane. Hamilton Lane is one of the largest private asset managers in the world. At present, they manage over $800 billion across their entire portfolio. Many of you have asked questions about the private equity industry today, pricing, and we thought it'd be important to host an event. So we're actually going to host it here in Scottsdale. It's going to be on November 16th, which is a Wednesday. It's important for those of you that are able to attend. We obviously, it's going to be limited seating because the place we're holding it can only hold so many people. But Drew's an important part, and we think Hamilton Lane has been just an amazing partner that we've had over the last couple of years in terms of performance. So Drew will be coming out, and I hope all of you are able, that are local at least, are able to attend that event. So with that, I'm actually going to turn it over now to Nick, and he's going to start the 3Q market review.
Great. Thank you, Kurt. Hello, everybody. So typical on these webcasts, we're going to first cover kind of 3Q market review, and then we have a bunch of slides in the second half that talk about the market outlook. So this first slide is hopefully becoming familiar to everyone. This lists our current active tilts in the portfolio. We have 8 active tilts today, and they're kind of labeled by the blue bold lettering. So wherever you see blue bold lettering, that's where we have active tilts in our model to those asset classes. As you can see by the green and red numbers here on the right, this is the 2022 impact through September 30th, and 6 of the 8 tilts in the portfolio are adding value to client accounts. The 2 smaller ones, the 2 red ones, are actually smaller tilts in the portfolio. So on an impact basis, they're haven't significantly impacted the portfolio on a negative side. The 2 largest tilts in the portfolio, the first one everybody's very familiar with. We've talked about this a lot over kind of the last almost 2 years now, but private markets. So if you invested in private markets and you're able to do it kind of based on our model with those allocations, private markets are outperforming public markets by 23% this year. Significant outperformance that we none of us may ever see again. The other one is the short duration versus long duration. We were concerned about low interest rates for the last couple of years coming out of COVID. Knew eventually that those rates were going to go higher. They've moved here significantly higher in a very short period of time. thanks to the Fed's posturing, but that decision as well has helped us sidestep some negative performance at the tune of about 5.1%. We put all these tilts together, kind of look at our core portfolio and each client has a customized allocation, and some are limited in how much of this they can take advantage of. But typical client is outperforming benchmarks by 4 to 8% this year, which we're very proud of. And then, this comes off of a significant outperformance in 2021 as well. 2021 was kind of the polar opposite of this year, right? We had a strong bull market, and in 2021, we were able to outperform by 2 to 4% for client accounts that, again, were able to implement these tilts. And now in a significant bear market, also being able to outperform is exactly what we wanted to see from the portfolio. And we've talked to some of you about this concept of an all-weather portfolio, and portfolios behaving as we would have hoped and expected based on our research and our allocations. Here's the global markets. All major public market asset classes were negative for the third quarter and the year to date. At the end of June, when we talked to everyone, it had been the worst start combined for equities and bonds, worst start to a year ever. That's only accelerated here even more as both asset classes, stocks and bonds, have had negative third quarter performance. So this is kind of the worst start of a combined equity fixed income markets that's ever been recorded. The only positive returns came from semi-liquid private markets, which seem to be saying on a quarterly basis. It's a long time to remember now, but during the first 6 weeks of the third quarter, stocks rallied significantly. The Fed was kind of going along a plan. The market was comfortable with it and looked like markets were about to move higher. The Fed didn't like that. Inflation had not really come down yet or been hindered. So the Federal Reserve came out with extremely hawkish posture and commentary, sending the market significantly negative. So for the quarter, global equities were down 6.8%. Just looking at the equity landscape, non-US markets were down even more than US markets. And a lot of that was driven by the strong US dollar. Higher interest rates in US treasuries caused non-US investors to invest in those treasuries, sends our currency higher, and that hurts non-US companies. Commodities and public real estate, both negative for the quarter, and so was all the different bond indices. The bond indices were driven lower, mainly again by that strong rise in interest rates. Coming into the quarter, the 10-year Treasury bond was at 2.98, so just sub 3%. It ended the quarter at 3.76%, and today we're just under 4%. This is the highest level that the 10-year has risen to its yield. We have to go all the way back to 2008 to get to a similar level. The Fed has raised rates significantly. Matt's going to talk about that a little bit more, but the rate now is over 3%. Unemployment's come in, and core CPI inflation, which is the broadest gauge, sits over 8%. And core PCE inflation, which is what the Federal Reserve looks at, it excludes food and energy, is hovering around 5%. So the Fed is looking for these numbers to start easing before they start easing in their hawkish posture. This is a new chart for the quarter. This is a scatter plot that plots for each of these asset classes on the page, their risk and return over the last 12 months. So if you're down here in the bottom right quadrant, you have high risk, so you're taking high risk and you've had very poor returns. If you're up here in the top left quadrant, you have high returns with lower risk than the other asset classes. So at the end of 2020, a lot of you remember this, we were very concerned about rising rates, higher inflation, and elevated equity valuations. Equity had rallied significantly on the back of the Fed, the back of coming out of COVID. And we were just looking for new investments, new tools in the toolbox to shift client assets into to avoid higher interest rates, equity selling off, and higher inflation. So we shifted from global equities and core bonds, right? Both have had kind of significant negative returns this year with higher volatility. And we shifted into private real assets, private equity, and private credit, specifically discussing here our 6 semi-liquid investments and the 7th that we recently added. But all these have produced significant positive returns with much lower volatility in the market, enabling us again to outperform client benchmarks who have been able to take advantage of these investments.
And looking at this, we'll pivot a little bit to get into some of the details of what Nick was talking about before. But this is the year-to-date trajectory of the 10-year US Treasury bond yield. And we see upward movements from about 1.5% at the beginning of the year to almost 4% at the end of the quarter. Now, the meaningful rise in rates due to Fed policy action, as well as inflation expectations, has roiled bond markets, as we saw, and created one of the worst bond bear markets ever. So we see that so far year to date, the Federal Reserve has hiked rates 3% so far in 2022, with additional hikes set for the next Fed meeting in a couple weeks, as well as in the December one. And our decision to cut interest rate risk in client portfolios and remove rate sensitive bonds in favor of floating rate and private credit has been a huge benefit to our clients. I'll also point out that the 10-year yield has not risen in aggregate as quickly as the short-term Fed funds rate, and this implies a flattening of the yield curve. So we've proactively shifted clients to short-term bonds where the yields are now comparable to other bonds with several years or even a decade until maturity. Now, once rates normalize and the Federal Reserve steps back from its aggressive inflation busting posture, we'll look to extend back into some of these more opportunistically priced fixed coupon bonds. On the next slide here, we see the disparate impact of interest rate sensitivity on bond returns this year. So this is a performance of 3 tranches of investment grade gov credit bonds, with one of them with maturities of up to 3 years. That's the short one. A second one, which is the broad credit universe, which is government credit bonds of all maturities, and one that's specifically long maturities of government credit issues over 10 years. In a market regime where inflation surprise is a main driver of risk, the correlation of stocks and interest rate sensitive bonds turned positive. So in this case, that correlation occurred with both assets going down over the course of the year. This pronounced pain in many ways is a give back of the exceptional returns of fixed income as an asset class over the Super Bowl bond market, which started from high interest rates in the early 1980s and were further magnified by quantitative easing and excess liquidity due to loose Fed policy. Now that liquidity and that loose policy is being removed and pivoting, bonds are coming under significant pressure. So this really puts the proof in the pudding of the impact of being too extended from a interest rate sensitivity perspective, and that you need to really manage your risks where that's concerned. So on the next slide, this is going from fixed income. Now we're going into equities. This is a view of the roller coaster in risk assets over the course of the quarter. So as Nick said, the first 6 weeks of the quarter were very strong from the bottom of the end of the month of June. Worst starting half of the year in modern market history. Many of our sentiment indicators were at contrarian levels to where there was likely to be a snapback. It's exactly what we saw in July. Rally from the bottom. July was a very strong month, and then after we got into the first 6 weeks, the Fed hikes came in line with market expectation. 75 basis point hike. However, the commentary used much harsher language that hinted towards the risk of the Fed potentially overshooting and hiking more aggressively than is actually needed, and potentially causing recessionary risks to rise. So since that time, at that peak, global stocks drew down almost 18% in 6 weeks. So our decision to move to private markets and implement the innovator ETFs, the buffered solutions that have some option overlay protection for certain clients, have added significant value amidst this heightened level of volatility. Increases of 11% and drawdowns of 18% in a 3-month period, generally are not things that we're used to experiencing over the last 10 years.
Now we're going to shift focus and look kind of at the global market outlook. First, a familiar slide, our capital market assumptions. So we've mentioned a lot how rates have risen significantly during these first 9 months. That's significantly impacted kind of cash and core bond returns. 9 months ago, 12 months ago, 2 years ago, we were talking about near zero rate returns on our cash. Now that's up to 2.5%, significantly higher than what it's been over the last 20 years. Core bonds have moved all the way up to 4%. As Matt was mentioning earlier, the flattening of the yield curve we could see here as well. I mean, only earning 1.5% over cash to invest in kind of intermediate term core bonds is not the best trade-off, but we do like seeing higher yields out of bonds. High yield bonds and senior loans have held in much better than kind of core bonds. So those expected returns, they've moved higher, but they're still kind of lower than what we would have expected from a return over the last 20 years. As equity prices have dropped off significantly this year, that directly impacts the expected returns going forward of equities. So these have all moved upward somewhat significantly. U.S. large cap market has held up the best across these different asset classes, better than non-U.S. markets. So even though we've had improvement here, we're still sitting at about 7% expected return over the next 5 years going forward, where small cap, international developed, and international emerging offer a nice risk premium over U.S. large cap. When we compare all that to private markets, we still see a nice return premium, excess return coming from our private markets over public markets, even though they have moved higher. So, if we can get 9% out of credit relative to a 4% out of core bonds, that's still a 5% excess return, still very attractive. And we look at private equity at a 12% return relative to 8.5% from global equities, and that's still a little bit higher than what we would have expected over the long term. So continue to have our posturing towards private markets here going forward. We talked about the flattening of the yield curve, so I thought a good way to reflect that and reflect the impact of a very hawkish Fed was to show kind of these 3 data points. So if we go back to the beginning of the year, we go from 1-month bonds all the way to 30-year bonds, and you see this nice slope of the curve. That's typically somewhat what you would expect. You expect to not earn a lot of yield if you're lending your money to someone for a short period of time. But if you go out to 10, 15, 20 years and you're going to let somebody borrow money for a long time, you expect to be compensated for that. So not an exact normal curve, but more similar than what we have today. If I move forward to where we were at 9/30, you can see if we compare the 6-month bond here, which is about 3.9%, to the 10-year 3.8, this is what we would call an inverted yield curve. You can earn more yield from investing in 6-month bonds than you can from 10-year bonds. So nobody necessarily who doesn't have a specific reason would invest all the way out here at 3.8 if they can invest at 3.9 over here. And if we compare it to the beginning of the year, at the beginning of the year, 6-month was about 0.25%. That's gone up almost 3.75% to 4. So a huge increase, again, on the back of the Federal Reserve raising rates, where the 10-year bond has only gone up 2.3%, significantly less than what the 6-month has. So as Matt mentioned earlier, we're going to invest down here for now. We'll take the higher yields with lower duration, and if the curve does at one point, which it should over time, come back to a normal slope, we'll look to move out on the curve and make sure that we're getting a nice yield for the duration we're taking in the portfolio. We spent a lot of time talking about inflation today, and it's all over the press. So these are the components. We get this question from now and again. What are the components of inflation? So this is broad market inflation, not necessarily exactly what the Federal Reserve looks at, but these are the components. So shelter, that could be rent, or if you own a house, they look at how much you could rent your house for, and that's a big factor that goes into inflation. Commodities, apparel, vehicles, other things that people buy on a daily basis, that's 21%, and then food and energy is about 22%. When the Federal Reserve looks at their measure of inflation, they exclude food and energy, and that's been a big. Some of the market pundits, some of the experts, economists, they're saying the Fed is missing the boat a little bit with their hawkish tone today because they're not factoring in the improvements in global food and energy. So we have 3 charts I'm going to show you now to kind of show you that there are some improvements in some of these metrics that roll up to the Federal Reserve, but just roll up to inflation in general that you don't really hear the Federal Reserve talking about today. So the first one is just global food prices. This is an index that tracks global food prices across the globe. You see they steadily moved up through 2021 into 2022. We had the supply chain constraints, and then skyrocketed in March. Right, the prices went significantly higher. But we've had kind of 5 straight months now where that's kind of normalizing and dropping back, which again the Fed has not been factoring in or talking about. The gas prices in the summer significantly high. Every night on the news, you heard about how high prices were in different parts of the country. Those have come down significantly. Not as low as they were in 21, 22, but normalizing. And the last one is just home prices. You look at home prices in 2021, houses were on the market for less than a day and they were selling for above ask, all cash offers. Since then, mortgage rates have skyrocketed along with federal funds rate and interest rates in general. It's made it much more expensive to buy a house. So we see home sales, dropping over the last kind of 7 months. So there are improvements in some of the inflation factors. It's going to take time for all this to flow into the system, flow into the Federal Reserve's policies, but we do see some improvements, which is a positive sign.
Taking a step back into the capital market side outside of inflation, this is sort of an evergreen slide that we look at. This is the level of valuations. So it's basically the price of the market, based off of its fundamentals. And what we see here is that the U.S. large cap market, so represented as the S&P 500 here, although we see that it's come down significantly from its peak, it's still elevated relative to its international counterparts, international developed, international emerging markets. So one of the things that we look at for our forward-looking capital market assumptions is valuations, as they are some of the best predictors of longer-term forward returns. Particularly ones that the real returns. If you take this particular valuation metric and you take the reciprocal of it, that's an estimate of the real forward earnings yield. So that's basically a way for us to look at where we would like to allocate our capital over long periods of time. So this is sort of a setup to say that although markets are very risky, there are some opportunities out there, particularly on a relative basis. And if we zoom out to a large enough time frame, this is something that we obviously monitor and combine with our other indicators. But valuation is very important, and the U.S. is not quite to the level where we feel it's great on a relative basis, but relative to its own history, it's definitely come down to more of a fair value. In fact, maybe even a little bit below its fair value level. We can actually zoom in on the next slide a little bit deeper here. This is the S&P 500 valuations. We've changed it a little bit. This is the forward price to earnings ratio. So this is based off of analyst estimates of earnings. So this is taking into account the fact that earnings are slowing down in this leg of the cycle. Inflation pressures are hitting the bottom lines of businesses, and we're basically comparing that to the 30-year history. So that ratio was at about a 17.3 over the last 30 years. As of the end of the quarter, it was sub 16. So looking at these various valuation metrics that we have inside the box there, regardless of how you look at it, there's some opportunities to be had. So the Shiller PE, which over the last several years has been extremely elevated to the long-term average, is actually close to its long-term, that 28. Didn't know if we'd see that for a while. And then other things like price to book and price to cash flow are far more in line than we had seen over the last leg of the cycle. And so as we look towards the next 10 years, that indicates that from where we were, expected returns are probably going to be a little bit closer to historical averages, maybe not meeting them because there are other implications such as inflation and the rate regime, but definitely closer where we were than where we were a year or two ago. Now, I think one of the things that we talked about also was the international markets performance, and one of the key drivers of that as a U.S.-based investor is the performance of the U.S. dollar relative to a diversified basket of international currencies. So this chart basically does a couple things. So we have the green bars are foreign companies when you've removed the impact of converting back to the U.S. dollar. So if you were an investor in those economies earning local currencies, you would actually have outperformed, those companies outperformed U.S. companies in 2021 and 2022. 2021 by about 5 percentage points, and in 2022 by about 10 percentage points. So the companies themselves, the operating businesses, have been outperforming their U.S. counterparts. But because we are U.S.-based investors and have to convert that through the lens of the U.S. dollar, the strengthening of the U.S. dollar has negatively impacted U.S.-based investors investing in foreign markets. And so the U.S. dollar movements in the US dollar are also cyclical over the long term. And so this US dollar strength is something that maybe wasn't totally anticipated, but generally tends to be mean reverting over the long term. So again, another supporting pillar of the case for at least not being severely underweight international markets, as many of these forces, valuations, US dollar strength and cyclicality, and some other key macro components could potentially cause some of the US outperformance to reverse over the next couple of years. Then finally, last thing that we'll look at here is looking at one of our tools and solutions for dealing with market volatility and uncertainty around Fed path to rates, the potential repricing and multiple contraction and downside in equity markets. These are the innovator buffered ETFs. So they are fully liquid ETF strategies that provide a 15% returns buffer over the course of a 1-year time horizon. So they basically make you whole 15% of negative returns. In order to fund that protection, they do that by giving away the upside past a certain point, what we call the cap of the strategy. So just as an example for US small cap represented by the Russell 2000 index, if from October 1st to September 30th of the subsequent year, the Russell 2000 was down between 0 and negative 15%, you would earn a return of 0% minus the expense of the fund. If it was down 20%, you would get paid 15% of it and you would net negative 5. However, if the market rallies and goes up, you participate 1-for-1 in the price appreciation of the index, not with dividend return, but the price appreciation up to that cap level. So up to 24.3%. Now, if the market goes above that, that is the maximum you can receive, and that remainder above 24.3 is given away to whoever holds the opposing contract. But this allows us to put some protection in place and allow us some upside potential, which is a couple multiples of what the expected returns for these asset classes are. Allows us to sort of step down our risk profile, but be able to participate and not be completely de-risked to where we miss an inflection point after the market turns on the bottom. So these have been a great arrow in our quiver for the year to date, and we'll continue to use these moving forward. We've actually looked to increase these allocations as uncertainty has grown, and we'll continue to utilize them in client portfolios moving forward.
Okay, so I'm going to finish up. These are kind of action items that we've put together for the balance of this year. We're going to begin looking to do tax loss harvesting and taxable accounts. We're actually going to initiate that program next week. We've been doing some throughout the calendar year, but if there's still losses to be harvested, we'll be utilizing those. And it's one thing we're going to actually be doing to increase our innovator exposure. Some of you have already taken your 2022 IRA RMDs. For those of you who have not, we'll be sending out the paperwork for you to sign to execute those. Historically, we've always done them in early to mid-November to allow the IRA to grow compounded for the longest time period. That normally works. This year, obviously, with the markets being down, it is not, but we'll be executing those in about another month. And then we have a new private credit portfolio that we likely will be bringing to you as a formal recommendation sometime at the end of this quarter and the first quarter of 23. It's a manager that I think Nick, Matt, and I have talked to you about many times, and so they're putting together their portfolio. So that will be the third semi-private credit manager. I also want to finish up because we're kind of at our 30-minute timeline. We're proud to announce that we added a new team member. Debbie Hodge joined our firm earlier this summer in the operations group. So she's working directly with our internal team to doing a lot of work on the website, on a lot of the data inputs into the website, and we'll see her role grow. So we're really excited to welcome Debbie to the team. So with that, I'm going to end the webcast because we're at our 30-minute timeline. And as always, reach out to any of us individually. We look forward to working together. And once again, thank you again for your trust and confidence. Have a great afternoon.